be, as I like to say, the prettiest girl in the ugly girl contest. And so that continues to, hey, so you laugh at that one. Everyone, and let me start by thanking you for joining us this afternoon and giving me this opportunity to speak with you as I present the economic outlook, looking beyond the first half of the year. Now, if you remember, the first half of the year was a little bit volatile. We had a very slow start out of the gate. We did see a pickup in momentum in the second quarter, but now as we look out to the second half of the year, the question is, will we be able to maintain what we saw in the second quarter in terms of growth? Will we see additional momentum in the economy? Or will it slide back to that general malaise that we saw across the first 3 months of the year? Now, really when we talk about the economy, I think there are 3 key questions that we want to address. One, what will monetary policy look like in 2015 and 2016 and beyond? Also, what is driving the Fed to make that decision as we still sit here at least a 3% pace on the back end of the year in the latter 6 months? Unfortunately, we think that is going to be impossible. We still think the economy is going to grow at a positive pace, but at much less than 3%. We're looking at around 2% GDP. So again, coupled with a 1.5% average in the first part of the year, that gives us an average annual rate of 1.8%, well below the Fed's outlook for growth. So again, the Fed overshooting what is likely to come into reality. Now, one more thing I want to point out about the Fed before we move on to the data is that we've almost become obsessed with pinpointing the exact timeline for liftoff. Will it be the September meeting? Will it be the December meeting? Or as I suggest, 2016? But really the more important question is, what will the pathway of rate increases look like even after that initial rate increase? And what we do know is that rate increases after the first liftoff will not look like this chart behind me. We've heard from Fed official after Fed official that this time around the tightening cycle will not be like what we saw in 2004 when the Fed was wed to the idea that we had to raise 25 basis points at every meeting. We went from 1% to 5.25% in under 2 years. This time around, we could see a 25 basis point increase, pause, another 25 basis points. We may only see 50 basis points of an increase on an annual basis. That means, assuming again that 50 basis point increase, getting to a longer-term target of 3% or above on the Fed funds rate, that's not going to be a 2016 event. That's not going to be a 2017 event, 2018, 2019. We're talking about getting to 3% out in 2020. The Fed chairman telling us it may take years to get back to a new normal on the Fed funds rate. So again, every night when you're debating when the Fed is going to lift off, think about the more important question, and that really is the eventual pathway for rate increases. And I think that's a good segue now to the next question, which is, what is the Fed watching? Now, we know the Fed has a dual mandate, stable prices, full employment. And the Fed will not sway from that mandate because the market is growing impatient. The Fed will not sway from that mandate because of political pressure, one way or the other. Nor will the Fed sway from that mandate and raise 25 basis points just to see what happens, as some media heads have suggested. So when it comes to the labor market, really the discussion has centered around the civilian unemployment rate versus peripheral indicators. Now for the hawks on the Fed, the hawks meaning the ones that want to raise rates sooner rather than later, they're looking at 58 consecutive months of positive payroll growth. They're saying the labor market consistently adds jobs, and we've seen enough job creation that we've been able to reach and surpass the previous peak in total outstanding employment. with 11 million jobs created since the end of the recession, 3 million alone just last year. And in fact, the growth in the labor market, the Hawks say, has been so great that we've been able to drive down the unemployment to 5.3%. 5.3%, well within the range of what the chairman has told us is full employment, 5 to 5.8%. And we've been there since October of 2014. So the Hawks say this isn't a one-off report. We've been at full employment for quite some time now. So that's the hawkish argument. And at the upcoming September meeting, the Hawks are going to point to this chart and say, guys, we need to start raising rates. We're at full employment. But as Chair Yellen has said, labor market conditions have certainly improved. But further improvement is still needed to convince policymakers that the labor market is in fact strong enough to withstand a rise in rates. Because looking at the civilian unemployment rate doesn't tell the whole story. Looking at the 5.3% unemployment rate doesn't take into account a multi-decade low in the participation rate. That 5.3% pace doesn't take into account the fact that millions of Americans have looked out to the labor market and said, right now, conditions are so bad, I'm not going to bother looking for a job. And how do we calculate unemployment in this country? You have to be actively seeking a job to be counted. So I always say it's very easy to get the unemployment rate down to 0 if nobody's looking for work. Come on, that was funny. That's my best one. Now also that 5.3% unemployment rate, that doesn't take into account the millions of Americans that are working part-time that would rather work full-time but can't find full-time employment. It also doesn't take into account the millions of Americans working temporary jobs that would rather have full-time employment but can only find temporary work. So all of a sudden, if we add in all those part-time for economic reason workers, so the ones that are temporary or part-time that would rather work full-time, if we add in all those marginally attached workers, all those discouraged workers, well now you're not talking about a 5.3% unemployment rate, you're talking about 10.4% unemployment. That paints a very different picture, a much more dire picture of the U.S. labor market. And so now it makes sense why Chair Yellen and others have said, wait a minute, guys, we can't just focus on that 5.3% unemployment rate. We have to take a step back and look at the secondary and tertiary indicators to really understand what's happening in the U.S. labor market. Also, we talked about 58 consecutive months of positive monthly gains in terms of employment, but yet that's remained insufficient to absorb all of the slack in the labor market and put upward pressure on wages. Average hourly earnings have been bouncing around 2% since the end of the recession. At this point, we should be talking about 3, 4, 5% wage inflation. But the problem is the momentum in hiring is still lackluster. Now again, 58 consecutive months of positive job creation, but at what pace? At the end of last year, we were averaging 324,000 jobs on a monthly basis. That's now slowed to 225,000. And remember, we need on average 200 to 250,000 every month just to cover population change, just to cover demographic growth. Think of all the immigration, the first-time entrants, the college graduates coming out of the University of Florida looking for their job the first time. We need 200 to 250,000 just to cover that demographic growth. We're right now just sitting at 225,000. So again, positive job creation, glass half full, glass half empty, the momentum remains insufficient to translate into upward pressure on wages. Now I know you're saying that's the labor picture. What about inflation, Lindsay? And that's the next part that the Fed is watching. Remember, dual mandate, full employment, stable prices. Now, as I mentioned early on, every communication from Fed officials since December of 2012 has acknowledged the fact that inflation continues to run below the Fed's longer-term target of 2%. And Fed officials have acknowledged that, yes, some of that price pressure, that downward price pressure, has stemmed from energy prices, but some has stemmed from outside of the energy sector. Now certainly, looking here at crude oil prices, you can see that precipitous decline certainly translating into downward pressure on overall prices. But even if we exclude food and energy, we're still seeing that declining trend since 2011. But now, despite the fact that we have seen that declining trend since 2011, so for the past 5 years, the Fed consistently forecasts 2% inflation. So again, another sign of maybe how poor the Fed is at forecasting reality. Again, that yellow line being the Fed's consistent forecast, and the blue bars being reality as inflation has continued to slow and move further away from the Fed's longer-term target. In fact, as the Fed sits on the sideline waiting for inflation to reverse course, looking here, the question is really not when inflation will reverse course back to 2%, but what inflation? We're looking at the PPI down 0.8% year over year, the CPI up just 0.1%. Even the PCE, the Fed's preferred measure of inflation, you can see since 2011, both headline and core, which excludes food and energy, just to give us a less volatile indicator of price pressures, both continuing to decline from that peak back in 2011. The PCE up just a few tenths of a percent, the headline down from that 1.4% as of last month at 1.3%. So still declining from that 2% threshold that the Fed consistently tells the market, don't worry, we'll be there soon. Now the Fed, aside from the labor market, aside from inflation, back at the start of the year, the Fed added international developments to the list of policy considerations when determining the appropriate timeline for policy firming. Now under that umbrella, it includes everything from central bank policy around the world. It includes a rapidly rising dollar. It includes declining U.S. exports. It includes tensions between Russia and Ukraine. It includes a slowing Chinese economy. It also includes threats from turmoil abroad in Europe via a Grexit, or a Greek exit from the Eurozone. Now, right now, the market's attention seems to have been diverted back to fundamentals here in the U.S., as Greece appears to be gearing up for their third round bailout. But it's a little baffling that the market seems so calm with this infusion of cash, because this third round bailout does nothing to ensure that Greece won't return to the funding trough again and again and again. It does nothing to address the underlying structural issues of the Greek economy. It certainly doesn't address the fact that the Greek economy is facing over 25% unemployment. It doesn't address the fact that Greece is still facing very sluggish growth with mounting debt, debt to GDP ratio pushing up near 200%. Now, there's no austerity in the world that can bring that debt to GDP ratio back down in line with EU standards without sending that economy into deep, deep recession for years, maybe decades. And so when we look at Greece, the end game for that struggling economy in our mind is the exact same as it has been since negotiations began back in 2010, late 2010. And that is for Greece to eventually leave the Eurozone. Now, for the Greek people, the end game is the same, a decline in the standard of living. But from a political standpoint, when you have 61% of the population voting no to the very austerity measures that you're trying to push through and implement, from a political standpoint, it is much easier to sell inflation than it is austerity. Now, the Fed's concern about international developments has actually excelled into concerns over contagion from international developments or international turmoil, that including volatility in international equity markets. As we're looking here at the Shanghai Stock Exchange Composite Index, we have seen Chinese equities fall, that nice 30% day drop, of which only about 2 to 3% has since been recovered. One of the largest economies showing the slowest growth in years since the Great Financial Crisis, reported at 7%, but our estimates indicate that that is well overshooting, and it's more likely in the range of 4.5% to 5% GDP. Amid a collapsing housing market, prices down over 6% in China. I think we all remember how an economy responds to a collapsing housing market. And of course, the inability to create and sustain a middle-class consumer society. And what we see then is that translates into one of the largest consumers of raw materials, commodities in general, putting downward pressure, not just on energy, but look at aluminum, copper, steel. These are down 30, 40, 50% in some cases from their 2011 peaks. And what that translates into then is further downward pressure on import prices. Import prices were down 2.5% at the end of last year. Import prices were down 5% in the first quarter of this year. They are now down over 10% as of the latest July report. That translates into an even more benign inflationary environment here at home as we're importing deflationary prices from the global marketplace. So again, reinforcing the Dove's argument that the Fed need be patient and wait on the sideline for longer than expected. And of course, on a relative basis, as the U.S. continues to grow legs, still in positive territory, but on a relative basis, looking out to the sluggish growth of our European counterparts, of a struggling Chinese economy, we appear to be, as I like to say, the prettiest girl in the ugly girl contest. And so that continues to, hey, so you laugh at that one. So that continues to incite capital flows into the U.S., putting further upward pressure on the U.S. dollar. And you can see here that tremendous run-up that we've seen, up nearly 15% in just the last 12 months. Now, long-term, yes. Long-term, we want a strong U.S. dollar. We want a sustainable, dependable greenback. But in the short term, as the U.S. economy is still struggling to gain momentum beyond this 2% trend, well, a rapidly rising dollar does what to U.S.-made goods? Makes them more expensive, relatively unattractive then to international buyers, and that puts downward pressure then on manufacturing and exports, which are the two key components of the economy that were providing support if we look back to 2014, 2013. So instead, we're shipping revenue and business overseas rather than keeping that in the domestic economy, helping us to propel growth. So let's take a look at what the consumer's doing. Well, after a general malaise across the first 3 months of the year, you can see that 3 consecutive months of negative retail spending, we have seen a bit of a bounce back, but really an undiscernible trend as one month is then countered by flat, and the rebound then is even slower than the month before. So even the rebound months that you see there, we're losing traction on a monthly basis. And that continues to put downward pressure on the annual pace of spending. Still positive, glass half full. But glass half empty, we're losing that momentum from a 5% annual spending pace down to about 2%. Now again, still positive, but what's so concerning about looking at that declining trend is that it comes against the backdrop of this slide here. Lower gas prices. Who doesn't love paying less for gas? Saving money. And of course, all of that savings over the past year has translated into an average. Now this is assuming a one-car family, 20-gallon tank filling up 4 times a month, so you can adjust that if it's a multi-car family scenario. But if we do assume one car, 20-gallon vehicle, 4 Phillips a month, the average American over the past 12 months has saved nearly $1,000, $896.48. Now, I'm not going to stand up here and argue that that's life-changing money, but $900, $1,000, that is a significant amount of additional discretionary spending to use out in the marketplace. And what makes American consumers so great is that we have this multiplier effect. We feel wealthier because we saved nearly $1,000, so we're actually going to spend $2,000 out in the marketplace, $3,000. So the question is, if we have all that additional discretionary spending capabilities, why haven't we seen retail sales increase? Why haven't I had to adjust my chart and increase the axes? Well, part of the question is rising household costs elsewhere, particularly healthcare insurance premiums. Now, according to the National Online Private Health Insurance Exchange, health insurance premiums have increased 40 to 55% since 2013. That translates into an additional expenditure for the average American family up to $3,000. Let's add in one more variable to the equation, lower wage jobs. The jobs we lost during the Great Recession were high-paying construction jobs, high-paying engineering jobs, high-paying business services jobs. We replaced them with lower-paying admin jobs, lower-paying health and education jobs, arguably a net benefit for the economy, but staying with it from an income standpoint, lower-paying temporary jobs. So the jobs that we lost versus the jobs that we created on a weighted income basis pay 22% less. So you saved $1,000 at the pump, you're spending $3,000 more on health insurance, and you're making 22% less. Now it makes sense why retail sales haven't skyrocketed. Now on the other hand, what makes economics so interesting is that the way we calculate GDP is not on an annual basis, it's on a quarter-to-quarter basis. So when we look at the general malaise of spending in the first quarter, second quarter, well, even a modest. So I know that was a lot of information in a short period of time. Let me just run through a summary here. And I want to start with identifying the fact that there are signs of improvement. I don't want anyone to leave here depressed. We are taking steps in the right direction. Remember, recovery is never an easy process. It takes time. It's just taking longer this time. We've seen extraordinary accommodation for the past several years, but the problem is we've only been able to eke out 2% GDP. Remember, on trend, we've been seeing 2.1, and it's likely that this year, 2015, we fall below that trend growth rate. And really, we shouldn't be applauding or patting ourselves on the back for 2% GDP with 0 interest rates. 2% is the bare minimum. We should get 1% from population growth, 1% from productivity gains. So 2% is the bare minimum. At this point, we should be talking about 4, 5, 6% GDP. What was GDP in 2004 before the Fed started tightening? 4%. What was GDP in 1999 before the Fed started tightening? 4%. And by the way, inflation in both cases was 3%. We're now patting ourselves on the back for 2% and 0 inflation? Headline job creation, as I mentioned, remains positive, 58 consecutive months of positive monthly gains. But the pace of hiring remains insufficient to absorb the slack in the labor market and translate into upward pressure on wages. Despite lower gas prices, consumers still remain under pressure, shifting the goods and services in their basket rather than seeing a simultaneous rise across all categories. And remember, healthcare services now accounting for an even larger proportion of discretionary spending. Manufacturing and investment had been the silver linings to the recovery, but amid turmoil overseas, we now see downward pressure on exports and manufacturing as a rising U.S. dollar makes U.S.-made goods relatively unattractive. We also have a heightened inventory. Remember last year, that 2014 style rebound in the second quarter? We saw back-to-back quarters of above-trend GDP, and the Fed said, here we go, here's the recovery. Well, producers listened, and they ramped up activity to take advantage of record low import costs, record low financing costs. Consumption failed to meet that elevated level of production. And now we've seen several consecutive quarters of positive inventory development, which contributes to near-term growth, but eventually we have to eat through that stockpile of goods, and we do expect that to contract from growth in the second half of the year. Modest but positive. Looking for an annual growth rate of, as I mentioned, below 2%, 1.8%, keeping downward pressure on rates as it becomes a reality that the Fed will be on hold beyond that September meeting and into next year. And with that, I think we have about a few minutes for some questions, if there are any questions.
We do. And with that, we stand adjourned, and thank you all for coming today.